a bit about chapter 7, which I think you've all read and studied through. Go really good. You guys know what cash is, don't you? What I'll do is I'll let you guys read about what cash is. I'll just hit a couple of high points here, and then we'll start doing some problems that are going to drive you crazy in the chapter. I strongly encourage you again to work on your homework questions, right? I hope your answers were better than the principal students when I said, are you going to Moodle and then actually looking up answers to problems? That's 100% hell yes, right? I'm better than doing that. Okay, so, anyway, but let's talk about what cash is and what cash is not, just a little bit. On page 346, okay, what is cash, huh? So, certain items present classification problems. Post-dated checks, what's that? Somebody writes you a check and put a later date on it because they don't have any cash in their account. Why would you want a check like that? You know they don't have the cash in their account, that's why they're putting a later date on it. They're standing right in front of you and you can get at least something from them. And you take it. And then as soon as that date hits, you get that thing in the bank right away and hope there's some money in the bank at that point. They say, I'm going to get paid in a few days and the money will be there, that kind of thing, right? Okay? So, is that cash? Of course not. They don't have the cash in the bank, you can't cash it, it's not cash. It's still an account receivable. Don't record it as cash. That makes sense? How about an IOU? Somebody takes some cash out of a petty cash drawer, right? And you get petty cash out of it. And the president of the company comes in and takes cash out for lunch and puts IOU in there, whatever. Is that cash? No, it's an account receivable, right? Recorded as an account receivable. So yeah, okay. Travel advances. Somebody goes to work for you, or salespeople a lot do this, right? Actually, faculty do that, right? You can put in for an advance, and they'll give you the money for your trip, right? In advance, okay? Like for your costs which you're going to incur for travel. What's that? It's not expensive. You didn't spend it yet, right? You didn't use it yet. It's a receivable from the employer, right? Just is. It's not cash. Okay, so those types of things. Make sure you record it right. Postage stamps on hand are not cash. Right? So you go buy postage stamps. What are they? They're called postage stamps, right? Yeah. So they say inventory or something like that. Could be office supply expense or prepaid postage. We call it that. A lot of times about a meter. You buy the postage for the meter and you haven't used it yet, right? Postage meter. You know, in those environments, obviously. Oh. Okay, yeah, so that's, that's a prepaid expense in that case. Yeah, sure, all right. By the way, petty cash funds and change funds, those are cash, right? Cash on hand. Some companies have a lot of it. Kroger, right? A lot. Target, a lot. All the cash in the tills, okay? Some companies don't have very much. I bet Microsoft doesn't have a lot of cash on hand. But Ford, right? Everything's done on account, okay? Right. General Motors doesn't have much cash on it. I don't need a big company buys their cars with cash. So okay, good. All right, cash equivalents. It's cash and cash equivalents. Cash is really cash equivalents too. They go on down. Okay, so let's talk about cash equivalents. They say restricted cash and bank overdrafts. Okay, on cash equivalents, what are the list that they give you there? What do we got? Types of things you can have. Cash equivalents are short-term, highly liquid investments, readily convert to a known amount of cash. So if you park some money in a money market fund, that's really a cash equivalent, okay? Just going to be there for a day or two. Okay, so the types of things that they talk about, readily convertible to known amounts of cash, savings account, maybe it's still cash, of course. So near the maturity that they present insignificant risk of changes in value or changes in interest rates. Okay, maturities of 3 months or less. I really like this definition. What's a trading security? Securities that have, well, that you can only hold for a short period of time, right? How do you tell a trading security from a cash equivalent? It's kind of tough. Typically, a cash equivalent has very nominal interest. You're just parking the money. Versus a trading security, you're actually investing to gain change in market value. Does that make sense? Or significant interest, that sort of thing. So that's a good way to probably split those up. Okay? Kind of overlaps. But certainly anything with 3 months would be a trading security, isn't it? Typically. Okay? So the idea here is you're parking the money, just putting it someplace for a short period of time. Okay? Original materials of 3 months or less qualify these definitions. And so they talk about treasury bills. What's that? That's money for federal government, right? Treasury bill. Okay, short term. Commercial paper, what's that? Big companies, I got an extra $100 million. I don't have anything to do with it for a couple of days. I loan it to another company for a couple of days. I'm not kidding. And they have it for a couple of days, right? And I pay them interest. And banks will, intermediaries will help put this transaction together, right? So they use money for a few days, they come back using it, and I make a little bit of money, and then they give it back to me, right? That's the idea, okay? So there's commercial paper, money market funds I mentioned. You guys know what a money market fund is? You're investing in the stock market, right? But as they sell some of your investment products, some of these guys do. They sell your investments, right? And there's cash left on hand. They'll put it in the money market fund for a while until they reinvest it. Or if you're doing manage your own investments, you do that. So that's really effectively cash. Okay, you don't expect to earn very much on it. It's going to be there a short period of time. Okay, some companies combine cash with temporary investments in the balance sheet for all the reasons I just kind of listed, huh? So it gives you an idea. Okay, everybody got the idea? You need to know what cash and cash equivalence is. Because most people, when they say cash, it's cash and cash equivalents in the balance sheet. There we go. Okay? Restricted cash. We got some sort of restriction. This is restricted cash, restricted use. What if I can't use the cash account? I have money in a cash account, and I can't use it for more than a year. What kind of an asset is it?
Long term.
Long term, yeah. Cash is long term. Restricted cash. Got it? Also, if I can't use it, it's not my general checking account. I had clients that were insurance brokers. And they would collect money from their clients, right, that they're going to use to pay their insurance premiums, and they put the money in an escrow account for them. Those escrow accounts were not their cash, they were their client's cash. They had to separately classify it, right? By law, they couldn't use that for funds, they kept them real separate, okay? Separate checking accounts and everything. Okay, so restricted cash, so you need to know about what that is. Bank overdraft, a bank overdraft is a what? I wrote a check that's not any good. Right? Companies do it by mistake. Other companies try and use the float. What's the float? Used to be you could have banks on opposite sides of the country or around the world, right? And I'd write a check on a bank that was a long ways away from me geographically, and I could give it to somebody, and their bank would deposit in their account, but it'd take a number of days to clear the other bank. That's gone. Why is it gone? Everything's electronic. Boom, it's instant. So there's no float anymore. So what happens is an overdraft is really people screw up, right? And you get fees for this, perhaps. It doesn't how big an account you are, right? How much cash you got. Is that a true statement?
Yeah.
Yeah, so actually most of my life as an adult, I've had accounts where they wouldn't balance my checks, right? And as a courtesy, they just pay it and not even charge me a fee, just call me up and say, what are you doing? I've had it happen a couple of times. You try to be careful for something like that happen, right? Okay, but if you have a big balance sitting there in the account for a while, maybe you go on. Okay, but the idea is the company writes more checks than they have cash in the bank. That, you know what, you guys? It's not cash anymore. There's no such thing as negative cash. What is it? It's a bank overdraft, it's a liability. What kind of a liability? Let's hope.
Current.
Pretty current, yeah. The bank's going to want their money right away. And this is real embarrassing. So when you're in public accounting and you have small clients, sometimes if they're not real responsible, you have to call them up and say, guys, don't mail on the last day of the year, because it's the last day they're mailing them all out, and they know they won't clear that day, right? Don't mail checks, right? Write them in mailing that are going to make you have a bank overdraft on the last day of the year. Why? I'm going to reclassify your negative cash balance to a liability in the balance sheet, and then we're going to sit in the office of the banker when they look over your statement, because that's where you're getting your financing, and they're going to say, I thought you were banking with us. Where's your cash in the bank? And you have to say, well, it's over there in the current liability section. And then they laugh at you, right? And make fun of you. So don't do that. Or get angry sometimes, right, if you do it consistently. So I'd actually have a list of small clients where I call them up and say, you know, that's over that. So everybody got the idea? You got to reclassify that. They'll actually ask you questions like that on the CPA exam. Look at the little thing on illustration 7.2. Isn't that lovely? All the stuff I just went over, really quickly, they've got, I didn't talk about compensating balances yet, we better do that. But everyone's there. Know everything in the blue box, right? You already know that. Everything in the colored boxes. Compensating balances, what's this? What's a compensating balance? Oh, one other thing in the bank overdrafts. If I have more than one account with the same bank and I have the right to offset them, right? It's gotta be the same bank, separate banks, you can't do it. But if it's the same bank and one has a positive balance and one has a negative balance, bank overdraft, you can net the two of them. But you have to have the right to offset it. Everybody good? Makes sense? Okay, so, because you got the money in the bank, so you don't owe the bank money. All right, anyway, so they say if the right offset exists, we do reduce cash flow. Compensating balance is what? I borrow money, and the bank has a requirement that I put the money into a savings account, maybe, at the bank, or some sort of investment at the bank. So they loan me $1 million and they take $100 of it back right away. What did they really loan me? $900,000, right? By the way, they charge you interest in the whole $1 million. So they're charging a higher interest rate than it looks like. They only loaned you $900,000. And then maybe they'll pay you some interest, typically, on the money you put in your account. So they charge you 12% and then they pay you 2%. Got the idea? And that $100,000 you put in the bank. It's just that, okay? So you need to know what these things are, obviously. So what's that? Cash separately classified as a deposit maintained as a compensating balance. Classified as current or non-current on the balance sheet. And how would you decide? How long does it have to sit there? If your loan with the bank is a current liability, that's what the compensating balance is. Seeing as you're going to pay off the loan currently and they'll give you the money back. Right? You're not really going to pay them the whole loan. You're going to pay them the $900,000 and they're going to keep it $100,000, right? Okay, when you're done. Right? Instead of paying them the whole $1 million. Everybody get the idea how this thing works? Not a big deal, is it? Okay, so what if it's going to be more than a year? You pay them. Guess what? The cash is. The compensating balance, the cash, still classified as cash as what? Long-term asset. Got it? Compensating balance. Okay, wonderful. These are easy, okay? That's nice. Okay, so on page 349, this one's kind of fun. They're talking about the luck of the Irish here. What do the numbers mean? Everybody got that? Give me a book. Are you letting him look at yours? The men do not have books. Women only have books. Yeah, okay. Guys couldn't afford one. So the whole thing here is there's no tax forever. You got to read that. It's really fun. The accumulated unearned foreign earnings and the untaxed foreign earnings in the current year, untaxed foreign earnings as a percent of net income for all these big companies. You know, the whole scandal about never paying taxes. We ran across that trying to value Yum, right? Those of you trying to value Yum, what was going on? All of a sudden the tax rate skyrocketed. Why? Everyone's going after them. I think that's probably what happened with Eli Lilly too. So why the valuation was so funny. Why it has a negative growth. They haven't booked it yet, but I think people are expecting them to. That's probably what it is. Because it's strange that everybody would think Lilly would shrink 2% forever, right? And then 2.3 or 2.4%. Eli Lilly was. Something like that. Yeah. So maybe that, I'm hypothesizing that, I don't know for sure. Okay, so we're done with cash. That was great, huh? Receivables. All kinds of receivables separately classified. Oh, by the way, accounts receivable is a trade receivables. Some company in the normal course of trade, right? Your normal operations, call it trade receivable. We don't usually say that. We usually say accounts receivable, and everybody knows that's the trade accounts receivable. There are other kinds of accounts receivable from officers, accounts receivable from employees, accounts receivable from subsidiaries. Any related party has to be shown separately, right, guys? Read this stuff carefully. This chapter is going to feel, part of it is, and part of all of them are going to feel a little bit about like we did in 101, and also kind of like that got off of chapter 4 and 5, where it's just the shotgun. At least this is a little more directed, huh? Okay, but get the detail there. Okay, anyway, so they give you a nice list on page 350, and they show you a couple of examples of how to do the disclosures. Oh, by the way, look at all the disclosures, right? Look at those disclosures, read them, and see the differences. Note the differences between different companies. And throughout the book, you'll be doing that. So things we have listed here on page 350, advances to officers and employees, advances, and we separately classify those two. Advances to subsidiaries, and it'd usually be current. Deposits paid to cover potential damages or losses. So if I have deposits, that's really a receivable from whoever I gave the deposit to. Deposit paid as a guarantor, dividends and interest receivable, of course. Okay, and then claims against all kinds of people, including the government. Even returnable crates, right? with a deposit. And you can see Molson there. Remember I said that you can show things either on the face of the statement, or you can show it parenthetically on the statement, right? You know this stuff, right? You need to put it in parentheses, okay? Or you can show it what? In a supporting schedule, or you can show it in a note to the financial statements. And these two companies are doing things differently, aren't they? Okay? So, take a look at it, read it, and they just show how they would handle their accounts receivable, and they put their notes receivable together on one and didn't on the other. So, anyway, however you want to do it. How you handle your allowance. Some people have an allowance without accounts just for receivables. Some have one for receivables and notes. Some have one that's the two together. Some have one for receivables together. No big deal. Okay. By the way, when do you recognize a receivable? It's when you recognize the revenue. When you recognize the revenue. You guys already know this. Revenue recognition criteria.
When you do the service.
When you provide the goods or services, and the earnings process is substantially complete, there can be warranties with no right to return, right guys? Okay, and no substantial things left to deliver, right? And, go on. It's either, that means earned, delivered, right? Earnings process substantially complete. Something else has to be there. It's either what or what? Or recognize means recorded. This is the recognition principle. Realize, got it, good man. Okay, realize means I got the cash, or I don't have a receivable if I got the cash, I got the cash. Or it's realizable. Realizable means what? They owe me money, that's a trade account receivable, right guys? Or a trade notes receivable, if you're going to charge them interest and haven't signed a note, same deal, right? Debit notes receivable, credit revenue, make sense? Sales revenue or service revenue. Okay, it's realizable though, before I would debit a receivable. What does that mean? They have the intent to pay me plus the means, the ability to pay me. You guys have to know this, you guys. It's going to be on the CPA exam. It's going to be on the final, I guarantee you. Okay? Absolutely. You got to know this stuff. And you got to carry it forward. Keep it with you. That's what we do. Okay? So you're going to be the ones deciding whether or not to recognize revenue. What does recognize anything mean? Make a journal entry and put it in the financial statements, right? What does realize anything mean? Either receive the payment or make the payment. That's realization. Right? Gotta know that. Okay, tell me the difference between though. So it's recorded as the exchange price amount due from the debtor. Oh, why don't we discount? Why don't we discount these receivables? Trade accounts receivable, trade notes receivable. Why don't we discount? Come on. We should. You're not collecting it immediately. We should discount it. Record the sale at a lower amount. Record the receivable at its present value. Come on, tell me why not. It's the same principle, chapter after chapter after chapter, you guys. Why is it not registering? Because you're new, right? You haven't thought about it enough. And many of you haven't worked hard. Are not working hard. It's okay. It's up to you. You can do the same time you want. You got half the semester left in terms of points, so you can suck it up and go after it, or you can do this with me again. Or you can do some other career. You guys know who I'm talking to. Okay? It's real, right? This is a really, really good school. Why? Because I'm an ass, Alan Deck's an ass, Richard Schrader's an ass, Melissa Harper is a sweet person who will flunk your ass. Okay? And it's true. And the firms all know it. And they're all going to want to hire you. Okay? Go earn it. Let's go. A whole bunch of people in this class. This is a nice turnout today. I don't know what the hell happened. You know, it's cold outside. I don't know. Right? But it hasn't been all that wonderful. Review sessions haven't been very good. I don't care. You don't get a review session. I'll do it with one person. I did again today. An hour. It's already me. I don't care. It's an hour of my time. Take advantage of things or not, you guys. Go out there and look at the recordings that we do or not. Do yourself. Look up the answers, work the problems, look up the answers, do it if you want, don't do it if you don't want, I don't care. It's up to you, I don't care if people become CPAs or not, shoot. It doesn't work 1 to 100. Right? You guys have to get going. Get going, okay? And why wait until later? How many of you think you want to study for the CPA exam someday in the distant future? If you think you want to do that, I bet you'll never be a CPA. Right? And you might go, oh, I don't want to be a CPA, I'm a finance person. Not gonna happen. You're gonna throw away $1 million, maybe $1.5 million. What the hell's wrong with you? I don't care if you ever use accounting in your life. It doesn't make any difference. I passed the CPA exam. Oh, she passed the CPA exam. He didn't pass the CPA exam. Apply for the same job as a CFO someplace. See who gets hired. Takes you 2 seconds to throw away the resume. I'm not kidding. It's real. Unless you're related to the owner of the company. Look out there. They're really parent. Copy off. Yeah, okay, grandparent or something. Okay. By the way, my daughter is a financial vice president, and she never even took the CPA exam. So there are exceptions. Oh, absolutely. Absolutely. Right? Just want to play the odds? Right? Okay. So if she went over to Young Brands and applied for a job, though, they wouldn't take her resume. She doesn't want to work for a Young Brand, so it's not a problem. Right? Sorry. She wouldn't mind me saying that either. She had babies instead, and I'm really happy about that. Okay. Tell me what the difference is then between a trade discount and a cash discount. What's a trade discount? They're both in one operation. That's okay. Trade discount versus a cash discount. Did you read the chapters and principles where we did this? What's a trade discount?
Is it like when a company is buying supply or like materials from another company?
That they are going to resell.
Right.
Right. You were going to resell it. Okay. And typically that's where the cash discounts are going to come to. Right. What's a trade discount? It's a price reduction. You don't record a discount, you guys. It's just a price reduction. If you guys know that there's a list price at the places that we sell things for, right? There's a retail list price that the retail customer pays, which you might pay less than that if they're discounting it, right, guys? Okay. A lot of stores like to do that. They put the retail price on that nobody ever pays, and they tell you you're paying 10% less than that, and you think they have a bargain. You know what? Okay, they do that kind of thing. Okay. Wholesale works the same way, only it's a bit different. The wholesale list price, normal customers pay the wholesale list price. But if you're a real big customer, you might get a discount off of that. It's justified by the fact that you're buying a whole bunch. Or if you pick it up, you might get a discount versus if it's delivered. I mean, all kinds of things, right? If you're a particular type of customer, you might get a discount because you're that type of customer. You got the idea? But it's got to be the same for everybody who's in your category. You can't just say your friends have a lower price than your enemies, type thing. That would be violation of trust. Okay, you're not supposed to do that stuff. Okay, so trade discount is a reduction of sales price. So how are we going to handle it if the trade discount is 40% for somebody? The sale is 40% less, that's all. Everybody got the idea? It's simple. There's no accounting at all. You just reduce the debit to inventory and the credit to accounts payable for the purchase, right? And on the sales side, you reduce the debit to accounts receivable and the credit to sales. Right, guys? That's it. It's a trade discount. Okay? So you need to know that. Yeah.
So that's basically what they're explaining with the net measured and gross measured?
Now that's cash discount. Okay, now on a cash discount, what's that? It's for paying within 10 days or 15 days or whatever your terms are. And industries have different terms. And we really hate to give these cash discounts. They used to be 2% 10 net 30. What's the interest rate of 2% 10 net 30? 2% 10 net 30. Let's do that. What's the interest rate of 2% 10 net 30? 2% is 10 days. Or it could be 2% 15 days, or 1% 10 days, or 1% 15 days, whatever you want to do. Right? Whatever your industry does is typically what you end up doing. 2% 10 days, net 30. What does it mean, guys? It's 30 days. You never say the days. It's 2% 10, net 30. Right? What is that?
They can have a discount if they pay within 2% if they pay within 10 days.
You got it. And if they pay later than that, 11th day, they have to pay the full amount. When I was at Oster Mushroom Farms, we had customers who were waiting the 30 days and always taking the 2% discount and things. And I stopped it, and they were very angry. You always let us do it. Well, now you have to pay us 2% more for the product than if you're going to do that. I was a really mean guy. The marketing manager was good cop, bad cop. I was the bad one. Right? Richardson won't let me sell anything to you unless you pay us, was one of the things we did, right? Can't have any product. No kidding. You can't have stuff you're stealing from us. I didn't say that. I told him he should tell him that, right? And you also can't take discounts you didn't negotiate, okay? What's the interest rate annually for this? Tell me what it is. How much? 24. How'd you get 24?
About 2% a month times 12, but.
It's not 2% a month, though, is it? What is it? It's 2% for how many days? Anybody know how many days there are in a month approximately? 30. So how many additional days do you get to wait to pay? Nobody pays early ever, right? You don't do that. Time value of money. Everybody agree? Pay exactly on the due date every time. You get it in the mail on the due date. Sign check in the mail on the due date, or it'll unwire if you're doing it that way. On the due date, not before. You use the money up to that date. Okay, so that's just business. So it's 20 days you're borrowing, and it's costing you 2% every 20 days. So approximately what is it? Because really you only borrowed 98% of it, not 100% of it. So it's a little more actually. Okay, how many 20-day periods in 365? 18 1/4, right? Is that right? 365 20-day periods. Okay, what's 18 1/4 times 2%? A little better than 36.5%. How many would you like to earn? How many of you would like to earn 36.5% on your money? Wow, this is huge. What if it's a 1% 10 days? It's half of that. Getting the idea here? Okay. So why would companies let somebody have these discounts? You want to encourage them to do what? Give me the cash, pay cash. What's the best way to not have any bad debt expense? Have people pay you cash right at the time. Then you'll only have counterfeit money, right? Okay, that's your exposure. Okay, have them pay you right now. Okay, what's the next best thing? Tomorrow, the next day, the next day. What if I wait 30 days? Probably gonna have some bad debts. What if I only wait 10? I'll have less bad debts. Will I have enough less for 36% interest? I don't know. Right, now that interest rates are a bit low, these are more like 1% or 0.5% for the top. Make sense? It's business, you guys. This is business. So, do you want to let people wait, though, when it's costing you this much? Wow, this is expensive, isn't it? So that's all it is. Okay, what's the gross method and the net method? And we're going to have it both on the sales side, which is this is the receivable, so it's the sales side, and we're going to have it on the account payable side, too. You got to hope I asked you for this stuff, right? And I probably will, and I put it in the test or final ask you to do either accounts payable or accounts receivable, recording net and gross. What do you suppose gross is? Recorded at the gross amount of the sale. What do you think? Include the discount. Don't take it out. Don't take it out. Yeah. So leave it at the full amount. So if I give a 2% discount on a $100 sale, what's my sale with the gross amount and my receivable? The whole $100. What if I'm going to do net? It's a 2% discount. I'm assuming they're going to take the discount. Everybody in their right mind takes the discount, right, guys? It's 36% interest in this example, right? Or 18, or whatever it is. What do we do? You take the 2% out and you record the sale at 98. Got the idea? Or the purchase at 98. And the receivable or the payable at 98. Everybody good? Okay, now what are we going to do? We'll go and do it. We have another day on this chapter, don't we? That's a good thing. Yeah, because I'm not getting anywhere. You guys need to read the chapter. That would be really good if you did. I'd really appreciate that if you did. So would you. All right, let's do it. Let's do gross and net. Let's do 100. Let's do $1,000 purchase. Okay, let's do $1,000 purchase. Okay, and we'll do gross and we'll do net. Okay, let's do $1,000 purchase. Or I'm sorry, $1,000 sale. We're going to sell it. Okay, so debit what? $1,000 purchase, and let's make it 2% 10. That's fine. Okay, 2% 10, net 30. And in both cases, I'm giving them the 2% 10 days, net 30, right? Net 30 days. In both cases. Okay, good. What would you do if it's gross? Say it's January 1st, the sale. Debit accounts receivable for $10,000. Credit, sales, no big deal. Go ahead and record your cost of goods sold, of course, reduce the inventory, all right? Now what? Or if it's service revenue, then it's just credit service. I said 10,000 today,
Yeah.
or did I say 1,000? I don't know, let's do 10,000. Well, somebody threw out 10,000, that's what it is. I hereby decree, again, let's make it 10. Okay, what do we do on the net? How much is the discount gonna be? 2%, what's 2% of 10,000? 200, right? I love that, 2,000 would be nice, yeah, 20% discount. Okay, so what are you gonna record? Debit accounts receivable, how much?
9,800.
No kidding, that's net. Either one's just fine. Company just picks what they want to do, okay? Everybody good? If it was purchases, it'd be debit purchases. If I'm what kind of an inventory system? When I'm going to debit purchases, what kind of inventory system I'm using? Periodic. I get a 50-50 shot. Periodic. I periodically count, so I don't put it in inventory. I put it in purchases. Debit purchases and credit accounts payable for that exact amount. What if I'm using perpetual? Still credit accounts payable for either one of those amounts, right? And debit what? Perpetual. Perpetually keeping track of my inventory. Inventory, yeah, got it. Okay, all right, anyway, so fine. When we get to that chapter, you'll see it. Okay, current liabilities, big deal. All right, so if they pay within 10 days, that will be exactly January 10th. What do the entries look like if they pay on January 10th, you guys? What'll happen? That's if they pay January 10th.
Cash of 9,800.
Debit cash, 9,800.
Cash and discount.
You bet.
200.
Sales discounts, we call it. And those are cash ones, right? You don't call it cash really, because there's sales discounts and there's purchase discounts, both, right? And purchases, guess what? It's a purchase discount. Okay, so this is a sales discount, 200. Credit what? Accounts receivable. You better credit accounts receivable for the same amount you put in it. What do you bet? Huh? You wouldn't believe how many small clients I've seen that didn't. They have this balance in accounts receivable, and you ask them to show you what all their open invoices are, and you add up all the open invoices or all the accounts, all the customers' accounts, and you add them all up, and they have a lot more on the books than they owe them. And then you realize they've been leaving the discounts in year after year after year. It's hilarious. Okay, anyway. Easy to fix. So what would you do if it's the net method? Yeah. Credit what? What's the advantage of that method? It's simple. What's the disadvantage of that method? You don't know how much the sales discounts cost you. Right? If you don't show sales discounts, you just show your sales at net. What are you going to do if you're using a gross method? You're going to show sales less sales discounts, which is a what kind of account? Contra revenue, right? So you're going to show sales less that debit balance and sales discounts. That'll give you the same net sales. I got the same net sales either way, right? Okay, so the advantage is it's simpler so far for the net, and the disadvantage is you don't know how much your sales discounts cost you. Okay, so let's try if they don't pay. Say they don't do this, okay? They did not do it. When are they going to pay you? January 31st. You got it. Yeah, 30 days later. Okay, January 30th, I guess, really. Okay, so what do we do? Debit cash for 10,000 and credit accounts receivable for 10,000. Got it? There we go. Everybody good? Okay, what are we going to do on net? Debit cash for 10,000. Be careful. What do you want to credit accounts receivable for? 9,800. That's all you've got in accounts receivable. You have to credit it for 9,800, don't you? Tell me what the 200 is. Sales discounts forfeited. You got it. Now you got to tell me what kind of an account that is. Forfeited. What is that? Where does it go? Is it more? No, it's not more sales revenue. No, it's a credit. It's other revenue. Other revenue. It's done in the non-operating typically. There's another revenue item. What would you expect that number to be, by the way? If your customers are doing a good job, they have good internal control, and they're not broke. How many discounts are going to be forfeited? Zero. You'd expect that number to be zero. If it's not, I'd check out that customer. Did they just make a mistake, or do they do this all the time? If they do it all the time, they either have absolutely dismal internal control, which probably means they're gonna go broke someday and never pay me, or they're already broke and they're not gonna pay me, because they're already stretching. Is this an expensive way to borrow money, not taking your discounts? 36% interest, are you kidding me? When I went to work at those two mushroom farms, they were not taking their discounts. I made $20,000 a year the year I started. I saved them more than $20,000 by going to the bank, borrowing money at 12% interest, and saving the 36 on the discounts they weren't taking. The difference was how much? 24% times, I don't know, 100,000 or something. That's 24 grand savings for the year. Boom. I was a very popular guy. I got a raise after a month. Big one. Not to mention bonuses we got coming. Okay? So simple, you guys. So simple. Don't let your clients and your bosses do stupid things. Okay? Pay attention. So is it worth knowing about this? Oh man, yeah. By the way, what do you think most companies do? On sales, what do you think they do? Which method do you think they use? They use the gross, because they want to know how much the sales discounts are costing, right? They want to see it. But I'd still have my system set up so I knew when somebody didn't take one. I'd have a flag and tell me who they are. And then I'd check whether it's just occasional and so what, right? That means they have integrity and they went, it went too far, and, so they talk to their employees and have them, train them to not do that, right? Trust me, I train my employees to do this and my clients, right? You take your discounts. You never pay early, but you always take your discount from the days that you can take it. Okay, how about on accounts payable on the other side? It'd just be the mirror image, you guys, right? It'd be the mirror image. Only instead of calling it sales discounts forfeited, it'd be a debit. It's purchase discounts lost. And that would go down there under other expenses too. What do you expect the balance to be in that? Zero. It better be zero or somebody's going to lose their job, right? We don't pass any of our discounts ever. Okay? All right, so you expect purchase discounts to be nothing. So when you get to that chapter, you'll look at it again. It's just going to be the reverse of this, right? It's the inverse of it. You're just on the other side of the deal. Okay, which method do you suppose we typically use? What do companies usually use? The gross method or the net method on purchases, seeing as they expect to always take the purchase discount. They use the net. And what does that do? Then on their income statement, if there are any that are passed, we'll see that expense in non-operating income. You got the idea? For that loss, really. Purchase discounts lost. Isn't that a nice idea? So companies typically do that. Different for their sales and for purchases. Yeah.
Yeah, is this, after if they return anything?
Oh, what if they return some? What if they returned half of this? What would you do on a return? Let's do sales returns and allowances. That's fine with me. I don't care. So we got maybe what I'll do is erase part of this and then we'll do the discount. Okay. Let's say we return part of it. So we got the same deal, okay? But what we're going to do is have a return. So let's do a return first, and then we'll take the discount. Have the payment come in. They can take the discount. Okay, so let's do this. There we go. All right, so let's say this was on January 1st, so let's say January 3rd, they realized that we shipped them the wrong stuff, or they didn't need it after all or something, and we let them give it back to us, okay? So January 3rd, they return, let's have them return 1/4 of it, okay? So they return 2,500 of it. What would be your journal entry? Sales returns and allowances, which is what kind of an account? Contra revenue, right? Just like sales discounts. So this is sales returns and allowances. I'm going to show sales, less sales returns and allowances, less sales discounts is net sales on my income statement, right, guys? This is supposed to be just real familiar in your head. Okay, you need to know this stuff. You're going to be preparing statements for people. You're going to be looking at statements that are already prepared and find out if they're right or wrong. Okay? All right, sales returns and allowances, 2,500. Okay? Credit what for 2,500? Yeah, they don't owe me. If they haven't paid me yet, of course. Right? If they already paid me, I guess I have to give them cash back. Right? Okay, so credit accounts receivable. Now they only owe me 7,500. Everybody agree? Okay. What would I do if it was over here on the net side? They're returning a fourth of it. How much is a fourth of it? I don't know. I think receivables only 9,800. 2,450. So how much less do they owe me? 2,450. I'm going to take 1/4 of the receivable, right? 9,800. I'm going to lower it by 1/4 of it. Aren't you? Everybody agree? Okay. And then what am I going to debit? It's a sales return. Yeah, how about sales returns and allowances? Very good. How much? 2,450. Everybody got it? Not bad. Okay. All right. Then what would we do if they do take the discount? We'll go ahead and do all of them. Oh, by the way, what if I pay freight for somebody and charge them for it? I would debit accounts receivable, right? And credit cash or credit freight payable, right? And then later I pay it. Credit freight payable. Will I give them a discount on the freight I paid for them? No, of course not. How about if I collect some taxes or excise duties or something from them? Of course not. I'm only going to give them a discount on the product, right, guys? So remember that. Are you going to give them a discount now on what they return? If you want to do that, I'm going to buy $1 million worth of stuff from you and return everything, except for 2% of it. And then I'm going to tell you I'm keeping it. It's free. Deal? It's ridiculous. Nobody do that. So you don't give people a discount. They don't buy anything from you. Okay, anyway, so. All right, what would you do on January 10th when they pay you? How much are they going to pay you? How much are they going to pay you? Be careful. They're not paying you $7,500. That would be on January 30th. They'd have to do that. They owe you $7,500. How much discount are they going to get? 2% of 7,500. It's 150, isn't it? I think so. Cash would be 7,500 less the 150 discount, 7,350. Okay? I think the cash will be exactly the same here. Don't you? Keep going. How much are you going to credit accounts receivable for over here? 7,500. You got it. Sales discount's only 150. Nothing to this. What's the other side going to look like? Credit accounts receivable for how much? What's 9,800 less 2,450, you guys? It's a miracle. 7,350, so you don't have to do anything else, right? Okay. All right, let's change it. Let's say they didn't pay us on the 10th. Boy, there's an awful lot we could do, huh? January 30th. We could just do the class 40 hours a week if you wanted. I don't want to. Good. Just keep covering stuff. It's never ending. Never ending. January 30th, what do you think? So I have to do all of it on your own. Cash would be 7,500, you bet. How much you credit accounts receivable for? And we're done, right? It's fine. Okay. What's it going to be if it's the net method? What do you want to credit accounts receivable for? The amount that's left, right? How much is that? What's the 150? Sales discounts forfeited. You got it. Everybody good? It's easy. Okay, not a big deal. Okay, make sure you can do that kind of stuff in case I ask you something. Okay, and they show you the computation. They show it on top of page 352. Okay, I said that we evaluation the receivables. We don't discount them. Never answered me why. Why? I don't discount any of the current assets or current liabilities typically. Why? They're current. How big would the discount factor be? Extremely low. Be small. That's our idea. So the non-recognition of interest element is it's because it's immaterial. And the underlying concept in the box there with the magnifying glass, page 352, materiality means it must make a difference to a decision maker. That believes that present value concepts can be ignored for short-term receivables. Also short-term payables. Like it? Okay, that, you need to say that on the CPA thing. That's why, right? Otherwise, we should be discounting. You guys agree with that? Or maybe you don't. You should. Okay. That was fun. All right. You guys know how to do direct write-off method for receivables? We just did that. We did chapter 3, didn't we? Take a look at it again. When can you do the direct, oh, I'm sorry, the allowance method. When can you do the direct method? One is the direct write-off method. Notice what they're doing on page 353 is debit, bad debt expense, and credit accounts receivable. Is the direct write-off method directly writing off the receivable to bad debts? That's what the direct write-off method is. When is that okay? One, is it a violation of GAAP to do that? And that's what the kind of does. The answer is yes. When would it be okay to do that? You have to use the allowance method. When would it be okay to do that? When the effect is, just like the last one. Immaterial. That's it. The effect is immaterial. You don't have to follow any GAAP. The effect of not following it is immaterial. That makes sense? I think it's a really good idea when you have small clients to use the allowance method. You know why? Because it gradually creeps up on you. The allowance keeps getting bigger and bigger each year. The bad debt expense each year might be immaterial, right? The amount you would add to the allowance might be immaterial each year, the bad debt expense credit allowance. But what might tends to happen over time, that allowance gets bigger and bigger. And now you have to establish an allowance, say 5 years later. It's a great big credit. Guess what? You have to have a big debit to bad debt expense to go with it. It should have been spread over those earlier 5 years, and now the client's upset with it. Like, well, geez, that's a big number. You just wiped out, one-tenth of my income or something. And they'll say, well, why didn't we do that over time? Oh, because it was easier. So follow GAAP, okay? Better policy. So anyway, the allowance method, Nick realized we're going to get it. You know how to write off an account? After we do set up the allowance, it's debit, bad debt, expense, credit allowance. To replenish the allowance, what do? Debit, bad debt, expense, credit allowance, for whatever amount you need to. Typically, you're doing one of two things. You're either going to make the bad debt expense be the number you want it to be, right? So it's usually, it's zero when you start the year. By the way, might you record bad debt expense every month if you're doing monthly financial statement? Sure, you estimate it every month. Debit, bad debt expense, credit allowance, debit, bad debt expense, credit allowance, right? Or you might do it once a year, okay? That's establishing the bad debt expense, but what might you also do? And you should do also. Look at how big the allowance is, right? Of course. Because your net realizable receivable is your accounts receivable less the allowance. Everybody agree with that? So you want the allowance to be a good number and you want bad debt expense to be a good number too. They always work out that way. No. Because you're guessing how much you're going to write off. What happens if you write off a lot more than you allow for? The next year you need a lot more bad debt expense to catch up, huh? What if you write off more than you really needed to? What if you did bad debt expense and credit allowance for more than you really needed to, and now you don't need to add very much to the allowance? Guess what happens? You have a real small debit to bad debt expense. So 1 year's high, the next year's low, you got the idea. So you want to make the best estimate you can. But okay, what if you realize your estimate wasn't all that great? But it's an estimate, and you're in the next year. What do you do? What do you do with changes in estimates? We did this. You guys do know about corrections of errors, right? Those are prior period adjustments. An adjustment to the beginning balance of retained earnings, right? What do you do with a change in estimate, which is what this would be? The allowance should have been bigger or smaller, right? And therefore bad debt expense bigger or smaller with hindsight, right? You made the best estimate you could, but now you find out it wasn't enough or it was too much. What do you do with it? It's handled how? Not retrospectively. I'll go back to prior years. I make the change now and record it in the current year and into the future. So if it's depreciation and I'm changing, and I realize the life is too long or too short, and I change my depreciable life, what do? I don't go back and restate all those prior years, I leave them alone, right? Because that'd require a prior period adjustment, wouldn't it? Because remember, depreciation expense is closed over and over to retained earnings. So what do you have to do? You figure what depreciation should be this year and all the years forward. Make those be right for what's left to depreciate. Right, guys? What you do exactly the same thing with bad debt expense, or with warranty expense, or anything else you estimate. Okay? You know this stuff, you guys. Part of the problem, I think, is that we do this at night, which is god awful, isn't it? So it's 7:30 in the morning with that next semester. Sorry about that.
It's at 6 at night.
Oh, it's 6 at night? Oh, so you're gonna stay at 9, that's probably better than 7:30.
He starts all his testing because it's at 7:15.
7:15, oh, good. Anyway,
Yeah.
that's when 2:15 is from, yeah, anyway, whatever. He likes them. But maybe the problem is that it's late, if you guys, and I know you study hard for the tests, but you don't work in the meantime, and you're not very energetic when you come in here. Bring in caffeine or something, what are you doing? Right? I've got my principal students terrified that I'm gonna flunk them, so all of them are just clustered around here, just soaking this shit up. You gotta do something to get people going. Don't make me do that to you. Oh, that one, huh? I can't do it anymore anyway, right? I don't want to intimidate you into doing this, but you gotta, Jesus, you're sitting here. How many of you could right now do a quiz question for real credit on what we just covered? I just explained it, damn it.
I'm like,
What, do you want to study again? What for? Couldn't you just get it right now? When you guys go to business meetings, I don't want you to have a tape recorder with you and record everything, and then go back to your office and listen to what the hell happened in the business meeting. I want you to know what happened. Maybe I'll give you notes so you remember it later, huh? That's all you're gonna get. The key thing. I want you to know. And I want you to be formulating answers as you go. Are you formulating answers yourself in all of your classes as the professor is talking about it? Come on, you don't need to do that, right? Get yourself hopped up somehow. Caffeine. No speed, okay? Don't bring any speed in class. Caffeine's fine, okay? You gotta all bring a cup of coffee in here. Just be hyped up with me, I don't care, right? Then you can stay up and study this shit all night. It'll be great. Yeah, I don't care, right? But you guys gotta do something. Just, makes me nervous. Envisioning people interviewing you. Oh yeah, I'm doing fine. You know, I guess I was kind of on the job. That's not gonna work well, okay? You know what's really sad? We've got a guy, Zach Hagan, you guys know Zach?
Yeah.
He's in 212, working for GE. Isn't it Zach at GE?
Yeah.
Is it Digan?
that's
Digan, okay, whatever.
He wins the test.
D-I, not Egan, Deegan, D-I-G-A-N, I said Deegan instead of Digan. Sorry, I call him Deegan every time, he just leaves me alone, he doesn't care. Okay, anyway, he told me he's working at GE, he said that 6 other people from Bellarmine interviewed with him, and all of them blew the interview, and did not get an offer
Must be a person.
for an internship. Steve Tate, I'm gonna have him come and speak, by the way, next semester to my principals and intermediate classes. He coordinates their internships over there. He's a graduate from here. He's kind of a whiz kid, but mostly he just works his ass off. And he's a very discriminating fellow, and very demanding fellow. And people who go to work for him, their careers just stop. Okay? 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 All of you guys, don't just be so passive and mild-mannered. I hope in your personal lives that you are the sweetest, most wonderful people. You ever see me with my grandchildren? I make absolutely no requests of anything with them. They ask me for stuff and I do it, whatever it is, right? I'm not going to do that with you people, and I'm not doing that with you people. This is work, okay? So get to work, whether you're in class, whether you're at home, whether you're reading the chapters, read the damn things. I can't believe I'm telling you guys this late in the semester. This is a weird semester. I finally have the principal students going, now I'm working on you guys. And I know you do it for the test. That's not enough. Because I'm afraid you won't remember it for the CPA exam then. I'm afraid you won't remember it when you get in DEX class. You're going to be embarrassed. I'm afraid you're not going to come across like you really know what you're doing when you go to job interviews, okay? All the way around. I'm afraid you're not going to be able to do it when you go to work, okay? Get going. I have had semesters where I had people, I'd be wandering out of Horgan Hall, 10 o'clock at night when I was chairing and working on stuff. Because I caught a full load in my chair too, but I'm not over all the time. And so, I'm walking around and I walk by the classroom and the light would be on in there and there's nobody around and there'd be 2 or 3 of my students sitting in there. And what the hell are you doing? I don't quite understand this stuff. And those are the folks that, you know, go from a C plus into a B minus to a B to a B plus and go to work for you all. I'm not kidding. That's how you get there. Unless you're already there automatically. You're already there automatically, you got that kind of work ethic. This is work, you guys. It's just work. It's work. And it's continuous work. It's all the time. Come on, come on. And then when you go to work, you don't have to work as hard after you're really established. It's good. You won't, well, you'll be working hard. I don't think I work at all. I can be here 60 hours a week. I don't think I do anything. Doesn't make any difference. I could be working as an auditor 60 hours a week too. I don't think I do anything because it's fun and I know what I'm doing. Okay? This is fun, damn it. I'm trying to get you guys to do something. So, anyway, so please get going. All right, so on this allowance thing, what do you do if you screw up an estimate in the next period? Not a mistake. You just made the best estimate you could, and now you find out it's not that great. What do you do? Change the current year in perspective in the future. What do you do with every single change in estimate throughout the financial statements the whole time? Exactly. What do you do with the correction of every single error you made in prior periods, no matter what accounts they are? They're all close to retained earnings from the income statement, guys. What do? You adjust the balance sheet with one side of the entry typically, right? And if it's an error, right? Screw it up. Okay? You adjust the balance sheet and retained earnings for the prior years and hit the income statement for the current year portion. And there won't be anything going into the future, right? You could be reporting it right in the future. Okay, guys? Where do you put the prior period adjustment on the retained earnings statement? Where's it go? You start with the opening balance and do what? Add or subtract you got. That's it. So you're adjusting retained earnings from where it is on the last time's balance sheet to where it should have been. Right? We did this stuff, didn't we? You knew that. And how many of you knew this immediately when I was saying it, you just didn't open your mouth? That's terrible too, if that's the case. Don't do that when you go to work. When the boss says, who knows something, and you think you know it, have the courage to say so. And if you are wrong, they will respect you because you have the courage to say so. Don't do it when you know you don't know the answer. Okay? I'll get you on that. But if you think you know and you answer, and you know, well, they'll teach you. It's okay. And you'll be on the radar screen every time it works. I've been telling you guys enough of that crap. How can you estimate your allowance? You can take a percent of your receivables. How can you estimate your bad debt expense? You can take a percent of your sales. How else might you estimate your allowance? You could age them, right? Current, 30 days past due, 60 days past due, 90. And we look at our historical experience about how much of the ones that are current never get collected, which is almost none of them don't get collected, almost all of it does. So you take a little small percentage of those, right? The ones 30 days past due, probably a fair chunk, 5% maybe don't ever get collected. How about 60 days past due? Now you're getting into the 30% range maybe, depending on the company, right? How about 90 days past due? You're almost giving up, right? And so, and beyond that, even more. So that's how you establish your allowance, a percent of each one of those categories. Huh? You get that. What's another way to do it? That's coming up with allowance, right? So percent of receivables, or maybe doing 80, right? What else? I'll run through every single one of your accounts. Let's say you have big accounts receivable, but you only have 10 customers. What might you do? You're selling heavy equipment or something, right? You manufacture and sell it to 10 countries. Maybe do something, right? 10 big people, right? Military, different countries or something. What do? Analyze each one independently. Sit around and talk about what portion of this are we ever going to collect and what portion we aren't. Take your estimate on each one of the companies and do what? Add them up, that's my allowance for doubtful accounts. Maybe in some of the companies, when I was at Cold Springs, about, I can't remember, 82% maybe of our receivables were from Safeway. It's like Kroger on the West Coast, okay? Safeway. How much were they not going to pay us? If you had a big receivable from Kroger, how much was Kroger not going to pay you as a receivable? The number is zero. Your allowance that you need is zero. So doing the allowance is pretty simple on them. It's Safeway, and Safeway agrees they owe us this. Done, zero allowance, right? So our allowance is real small compared to our receivables. But what about that other 20% or so of our customers? Oh man, they were all over that. I worked to figure out who's gonna pay and who wasn't. But there's two reasons to do that. One is I wanna see the right allowance on the balance sheet. Two, I wanna see the right bad debt expense on the income statements. I got the correct income, right? And I got the correct net realizable receivables. What's the really big one though, the one I really care about? I want to collect the receivable. Ah, so I'm constantly monitoring. And you guys are gonna, if you're working inside a corporation, you're gonna be doing this. Obviously, if you're not, or a tax person outside in public accounting, you don't. They manage their own receivables. You evaluate whether or not they're managing them well, maybe, right? But what are you gonna be doing, gang? You're gonna be trying to get that money in. So you're gonna be monitoring how old they are. So of course you're doing an aging anyway. And you're gonna be keeping track of what percentage gets paid and what doesn't. You're gonna be granting credit terms to people, how much credit they should have, whether or not they should have credit. You're gonna be making all these decisions. Of course it's gonna fall to you, because you're gonna know what you're doing, right? Oh. By the way, is that a marketing decision, or is that a finance decision, or is that an accounting decision, how much credit you're going to send them? The answer is all the above. Right? You want to be a CEO? Make that decision. Right? They'll let you. People like to make all kinds of decisions. If people are sitting around wondering what to do, and the boss is gone, and you decide what everybody should do, guess what happens? You become one of the bosses. Because you made a decision. And you know what people will do if you make decisions? They'll ask you what to do. You know, you're working on something feverishly and they don't know what to do. You know what they'll do? They'll come up to you and they'll ask you what to do. So then you help them out by letting them do something. Suggest something to them. You don't have to get promoted, you guys. It just happens to you. You can't help it. Pretty soon you just run stuff. I'm not kidding. Okay? They'll throw more at you. Throw more at you. How many of you like people to give you more work to do? Let me answer this. How many of you like money? Learn to like people giving you work to do. And then find a way to get it done. Which can include, of course, training somebody else to do it. And they take it over. And they get some of the money. That's okay. Nobody minds. So, when I was at Wire Family Consulting, they gave me 55% of what I built. Right? And they gave everybody else 50% of what they built. Why did I get 55? No, percent. I build more, I got more anyway. Because I trained staff. I didn't get paid for that, and they knew it. Versus I trained staff that kept raising my billing rate because I was doing more important things. And I got 55% of the higher billing rate. And you just win the whole way, you guys. Develop some work ethic here, okay? And think of yourself as somebody who makes things happen. So take charge. I can see it developing in my one-on-one students and freshmen. Which ones are going to do it, which ones aren't. You guys are the ones who are going to do it. That's why you're sitting here. So do it. I guess you're leaving. Go away. We make sure that you have done assignment of receivables and factor with recourse and factor without recourse next time, because we're going to really pound on that, and it'll turn your brain inside. Okay, a little bit. It's really pretty simple, so we're going to do it. There's ways to get your money out of your receivables. You can pledge them, which is really what assignment is, or you can sell them, which is what factor is. You can sell your receivables to somebody, or you can pledge your receivables. That's what will be the hang up in this chapter. Right? See you guys. Sorry for the extensive pep talk. I had y'all here, so why not? That's a pep talk, by the way. I didn't chew you out. Pep talk. Yeah.
I think I'll stick with that.
Oh, yeah. Sure. You can get, get one of these from me. We'll do that for me. Yeah, I'm gonna be around. Did you already email me? Drop me an email. I'll go there in my office, right, I'm going there. I've got a couple of people I've got to get signed up, and then I'll give you a contact. You'll have it all, so. Okay. Yeah. Okay.
Where'd that guy go? You didn't even see him.
Oh, I gave you one that's key on. Well, I don't want to use that. Because it's the key.
Well, I guess.
I would have been good to have with me.
Do you have,
I don't know if the answers are right anymore because they keep changing things, so it might be risky. What's that?
do you have a take home test?
Green, I'm gonna run out. I'm gonna run out.
Is there a take home?
I thought I made it, huh? No, there's no standard one.
Oh, there's no take home.
There are multiple choice questions I turned into films. Huh. Drop me an email.
I better get on to it.
You have, key for chapter, or for quiz, chapter 4 and 5?
Yeah. Somebody walked away with it. Nobody do that to us with it. There it is.
Chapter 4 and 5?